On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects.
By the way, growing up in upstate New York, you know, like your Knicks, like these weren't, like we weren't that focused. Like Syracuse basketball in the Big East that was enough.
He loves Syracuse.
Do you understand what I'm saying? Like we bleed orange. That was enough. And you know how many people from Syracuse, New York, are like Cowboys fans or were like Michael Jordan
because
/
it's
Bulls
so disconnected
fans.
from New York City.
And Buffalo felt like a really weird thing. I mean, Buffalo, you guys were probably kids then, but I mean, I was in high school.
Thurman
But they
Thomas.
literally went to the Super Bowl 4 years in a row, and lost all four.
Yeah,
so they were like they weren't like this team that like you would revere. You're like, oh, what a bunch of losers, you know, because the AFC kind of sucked too, right?
You understand that whole region of the country, like it's an artifact of history that it even exists.
Yeah.
There's no reason why people would be living there.
Well, you know why? Because the Hudson River
I
went
know
straight
exactly
up,
why.
and then they built the Erie Canal to the Great Lakes, and
It
then
was really important
so
to the development of America.
Albany, Syracuse,
The canals were
Rochester,
the first
Buffalo.
blockchains.
Canal was the internet. Honestly, if
a
you
problem in search of an. No, I'm just kidding.
It's the opposite of blockchain. If you actually needed to move heavy things,
Yeah.
you needed to move it by barge. There were no railroads.
100%.
So also, there's no refrigeration. So that's why all the meat packing is up there.
Yeah.
But that was 200 years ago. What's the reason now?
Student of history. All right, this is Josh Brown. He is the CEO of Ritholtz Wealth Management with Michael Batnick, who is a
shout to Buffalo. What's up?
managing partner at Ritholtz Wealth Management. We never pod with Barry Ritholtz, the namesake of
You'll
your
never get a
fine
word
firm.
in.
Yeah.
Is that how it works?
Turn your mic off.
Okay, he does.
And ask him one question, leave the room.
All right, but he is a prolific podcaster. And he
he's
does
great.
the Bloomberg opinion, and oftentimes I'll see some really interesting takes that he has.
I think
with great
Masters of
guests.
Business started like 2017. He's been doing it forever.
Barry doesn't get his due for how forward thinking he's always been. He was the first financial blogger. Literally look it up.
Yeah.
That's number one.
Conference.
Number two, he's one of the first bloggers, not just finance, but period, to take a blog audience and do a live event around it.
Yeah.
Like this predates Kara Swisher. This predates anyone that's done it since.
The Big Picture Conference.
And the interview format podcast predates pretty much every single one in finance. None still live that started before.
Yeah.
And I don't think anyone has done it to that level.
Was he before Invest Like the Best?
Definitely.
Yeah.
I think Patrick was inspired by Masters.
Shout out to Barry.
But my point is, as many words that come out of Barry's mouth a minute, and it's a lot, you will never hear him ever say what I just said about his own shit. Never.
I want to talk about this, the business of this. The three of us have talked about this a bunch and like what inspired us to do some of the things that we're doing, besides the fact the things that we do in the markets every day. And I think that's really interesting. So again, Ritholtz Wealth Management was, you guys are an asset management firm, but you guys also are a very media forward sort of business.
So you were going to say very mediocre.
No, I was
very
not going to say
media
that.
forward.
No, I mean you really are. And so when you talk about inspirations, all that stuff's really interesting. Just as a quick housekeeping here, we're going to hit a lot of market stuff here, people. We're going to talk that we're recording this on the day that the Fed is going to be giving their presser after their 2-day meeting. We know what's happened with expectations for rate cuts. They have been pushed out. When the stock market started to rage in mid-December, when he had that presser, I think it was deck 13 or something like that. The markets were pricing in 6 cuts in 2024. Right now, we are not expecting a cut until the June meeting.
What markets were were pricing in 6 cuts? The bond market.
Yeah, the bond market,
not the stock market.
And that
stock market too, maybe.
Stock market really did. I mean, but all right, we're going to hit all that. I mean,
every rate cut expectation that gets taken away, the stock market goes up another 5%.
I know, and we're going to debate
but that's
that
true.
a
But
little
it's
bit.
also true that was the meaning where it was like, all right, we're done raising, and the market
correct. That was the clarity on the pause.
Correct.
Right.
Which means, finish that thought. So what does that mean?
I don't know, genius. What does it mean?
Well, I don't know, but I would infer from the stock market's perspective, cuts are fine whenever they come.
Yeah.
No one's screaming for one, not really affecting anything that matters. It's a small cap issue, and no rush.
Yeah.
The market has said we're good with the no hiking. It's like enough. It's enough
Josh,
catalyst.
the interesting thing now is that the further these rate hikes cuts get pushed out, market doesn't care. The market's still going up.
Didn't we say it's this asymptotic thing where they'll never come, but it's always going to be an upside catalyst?
Yeah.
So it's actually better if you never get a rate cut, and the market just keeps looking forward to it.
Oh, that's right.
Yeah, and listen, I think we've all discussed this. I mean, some of the kind of secular trends.
Isn't the anticipation of everything better than the thing itself? When you and I go into Fort Charles, the food's amazing.
Yeah.
But it's never better than the moment you sit down.
Fort Charles it is.
Yeah.
Like most things, though. Like, I can't wait to go to that concert. And then you go, it's like, all right, yeah, concert was great, but like the build-up is better. Yeah, the rate cuts are becoming that for the stock market. It's like, anything could go wrong, but remember, the Fed has 7 rate cuts in its pocket.
Yeah, but the one thing is that now you're starting to hear that we've actually had the expectations for cuts being cut in half and then pushed out to the second half of the year. Now you're starting to hear even like some very bullish strategists say when they finally cut, it's not going to be for good reasons. And that, so that's what we're going to be dealing with a lot over the next few months or so, especially if some of the data starts to slow. And
all right, well, let me ask you this. So you think that they're more likely to do an emergency rate cut than sort of like, all right, we're good, we can cut now?
Well, I think emergency rate cuts, and I remember what it was like, let's say in 2001, okay, when they did these emergency sort of cuts.
Let me rephrase that. Not emergency, but in response to weakening conditions.
Oh, I think that would be very bad. It would show a level of panic. And one thing I will say is, like, I think you have to go back and look at the history of Fed Chair Powell when he came in. I mean, remember they were calling it autopilot, the way he was raising interest rates. And I think a lot of folks were like, yeah, man, that's the way you should normalize interest rates, be, very forward as far as the way you communicate with investors and the like here. And he was doing a really good job until the stock market fell out of bed in late 2018. You remember that two and a half month period, and then they basically stopped the hikes, right? And then they moved to a more easy stance.
But that wasn't bad. 2019, the S&P did 30%.
Well, they did. Yeah. They stopped. They didn't.
Well, they stopped, but they stopped. Hiking.
Oh, that's my point, though. Yeah. The start of the rate cuts is not negative. The start of the rate 2019, you had 3 rate cuts in the first 6 months, and the market rallied 30% that year.
Yeah.
So, and there was good reason to cut. There was a trade war with China.
Yep.
There were all sorts of manufacturing-related issues. There was a pronounced amount of panic in the markets toward the end of the year. We actually bottomed on Christmas Eve.
Yep.
They weren't doing emergency rate cuts like there was an economic crash.
Well, they
just said we're tighter than we need to be, and the rhetoric has been way too hawkish. Here are some rate cuts, and the market loved it.
I disagree. When you say tighter than we need to be, that's assuming that it did some damage to the economy, that it slowed it up. The worry at the time was twofold. It was risk asset prices, okay, the way they were dropping precipitously.
That's not in the Fed's mandate.
No, I understand, but that was clearly the reason they did it for, and there was some worry about global growth because it wasn't issues about growth here in the U.S., but the U.S. stock market started to actually price in the risk that it was going to be imported, that weakness here. That's my 2 cents. And when you go back and you talk about, it's interesting that you mentioned that we were in a trade war with China. Look at the 2 things that happened. As the Fed was raising interest rates in 17 and 18 on autopilot, we did have tariffs, we did have this trade war, but we also had this massive tax cut. Right. And so there were 2 different things at play here. So I just think it's interesting. And those are things that are not in the Fed's pure purview. I mean, stable prices are. I think that if Guy were here, he would tell you, and, one of those stable pricings has been for risk assets. I know that's not what the mandate suggests, but stable prices in the stock market. And that's what they, in my opinion,
it's not in the PCE other than the fees that fund managers charge. Stable prices aren't in there. I think it's a little bit simpler. I basically think the Fed said something ridiculous around Thanksgiving in 2018. They said we are nowhere near, quote, nowhere near neutral, meaning they had a ton left to go. The asset price markets, to your point, responded really negatively to that. I think that did force the Fed to rethink making statements like nowhere near neutral. And then as the yield curve starts to invert into 2019, they know definitively that they're too tight. So you get these rate cuts, and I just don't think the market took that as, oh, wow, look, Powell thinks there's an emergency. And I bring this up. It's 6 years ago, so who gives a shit? But I bring this up because I do think that that's going to be relevant this time. If and when the Fed does the first cut, I don't agree that necessarily means the Fed is going to interpret that as, we're in trouble. I could be wrong. It's just not my base case right now.
So interesting. And again, why are we looking back at 6 years ago and looking how this Fed
It's the last cutting cycle?
Yeah, and to me, I do think it's like, but it's what's very different this time, Mike, is that the Fed was dying to get up to 2% inflation back then, if you think about it. And now, Fed Chair Powell has told us that they're not going to wait to get to their 2% target to start cutting rates, right? They're going to anticipate it. And that's what I think, again, by the time you're listening to this, we're going to know what Fed Chair Powell had to say and a little bit of the Q&A and that sort of thing. But again, I don't think any of us right here expect to be too surprised by this, and especially when you're starting to look and see what the bond market is pricing for cuts. But Josh had this post on the Instagram, Mike, and I'd love for you to opine on this. He said, when Wall Street says inflation, they're defining it in the terms of the rate of change from last month. When Main Street says it, they're referring to the current cost of living, not focused on the pace, but on the price itself. And I think this is going to be squarely the debate, right? And I think you really summed that up really well in an Instagram post. But now I want to hear what Mike Batnick has to say about that.
No, Josh is absolutely right. People don't care. Regular people don't care whether CPI or PCE or X shelter or whatever. They don't care what it did month over month or year over year. What normal people are looking at is, holy shit, I can't fucking believe how much things cost compared to a couple of years ago. That's it. They feel cumulative inflation. So when they see economists and Fed speakers debating about this, it's like maddening. It's like, what planet are you people living on?
Yeah.
So I also think, just in terms of the Fed, and obviously we have to talk about it, they're a big player on the field. They're going to potentially move the market later today or not. We'll see. I think it's probably they're not going to surprise anybody. The more likely you are to spend time focusing on the Fed and what they might or might not do, the more likely you are to twist yourself into a pretzel and cause yourself a lot of anxiety and probably not do yourself any favors when it comes to your own investing portfolio.
Yeah, so let me ask you this, though. And again, some of the data suggests, at least the economic data, that maybe the U.S. economy is slowing a little bit at a time where inflation is firming up, or at least the rate of decline. And again, the cumulative thing is really important. So, Josh, how do you guys think about that a little bit? Because that is the push and pull right now, right? Is about, like, if we do see an unemployment rate at some point over the course of the summer get up above 4% or something like that, right? And we do see inflation also, like, do we start pricing in what a stagflationary environment looks like for the stock market?
Don't say the S word. Come on.
No, but I listen, it's been 50 years, like in our lifetimes, we have not had to deal with that. And I do think it's interesting that some of the secular trends in technology, right? Like pre-pandemic, right? Automation, we were talking about universal basic income. We were talking about all these sorts of things, right? And now here we are on the cusp of one of the biggest, paradigm shifts in not just in technology, but what might do to the global economy here. And that will be on one level very deflationary, right? If you think about it, like, and then on other levels, it could be not. And one of the areas that you just mentioned, or we haven't really mentioned, is like wages. When you think about it as a component of services inflation, that may stay very well bid for knowledge workers, right? And then if immigration continues to be an issue, maybe we have it on the lower end of the employment spectrum also.
We've actually had a huge influx of legal immigration, illegal also, which infuriates people, and with good reason. But we've actually starting to recover the level of legal immigration. We went through a period leading up to the pandemic of virtually no immigration, and then it became actually no immigration. And however you feel about that, it's not a political debate. It's the reality of what that does at service sector jobs, manufacturing jobs. It turns out we need a certain amount of immigration just for our companies to run themselves properly. So we're now healing on the legal immigration front, and that has absolutely had an effect on ameliorating the wage price spiral that we were all worried about.
So you're less worried about that becoming embedded. You're saying that.
Look, I think the reality is that when you talk to regular people about the rate of inflation in the grocery store and how much it costs to eat out, first of all, we forget that 30, 40 years ago, most families couldn't afford to eat out. It was a special occasion. Now you have families that eat out 5 nights a week, like it's coming to them, right? But their parents, and definitely not their grandparents, did not live a lifestyle where eating out on a regular basis was something. So we all kind of get used to things that are relatively new. We all these things become embedded in our quality of life.
Luxuries turn into necessities.
Yeah. None of us want to give back. So if you're somebody that flew coach your whole life, and then in your 40s you said, you know what, I don't do this shit anymore. I need to sit first class. And then all of a sudden, circumstances make it so that you have to go back to coach. You are not going to be a happy camper. Okay, so this is the environment that we're in right now. And the one thing that people don't remember or they don't put two and two together is the fact that there have been huge gains in wages, especially at the lower end of the distribution. This is something that people really don't want to hear. Hey, you know why there's inflation? Because everyone in your income cohort is making 20% more than they were prior to 2020. And spending in a way that they were never able to spend. You're the inflation. Go fucking say that to somebody. See how they like
well,
it.
You can't talk about inflation without talking about assets, without talking about income.
Yeah.
Dude, it's the same disconnect. I'm sorry. It's the same disconnect as when you talk to a boomer about the first home they bought and they're still in it. And they delight in telling you, I bought that house for $40,000 cash.
Yeah.
Right? And then they tell you today it's worth $400,000. And you're like, all right, but that's like 1% a year.
Isn't this setting up
plus you paid taxes, plus you renovated it 3 times, plus everything that broke you had to fix. You really think this is the greatest investment you've ever made?
Right.
So when you introduce like data and inflation adjust things to people, like all of a sudden this thing that's like glowing in their consciousness, like how great they picked something to do, it's like, oh, shut up. Don't. And by the way,
likes data.
And my wife does that. I tell her how much money I made. She goes, "Yeah, well, we lose half in taxes." I said, thank you so much for that reminder. Yeah. I appreciate it.
So let's look at something on the consumer end. So we're seeing Capital One made a bid for Discover. Okay, when you think about that, one of the areas. I mean, they're going to take out thousands and thousands of jobs. Then they're going to integrate generative AI tools, right, to kind of help accelerate that sort of thing. And I look around and I say to myself, how many industries are going to be disrupted like this? All of them, right? And so I guess the point that I want to make really...
But disrupted doesn't have to be bad.
Disruption good or bad?
It doesn't have to be bad.
Well, the way that technology is accelerating right now, so we could have made these same arguments. If you were like a forward thinker in like 1998 and you saw all these companies going public, right? It was eBay, it was Amazon. So e-commerce was going to get disrupted by those two companies. And you could kind of look ahead and say, things like email were going to be this massively productive sort of tool. And, there's a whole host of things.
Dude, look what happened to the malls. Are we any worse off because malls blew up because brick and mortars were severely disrupted because Bed and Bath isn't here anymore?
Yeah.
Are we as a society, are we worse off because of that?
No, I mean, but Amazon finally fulfilled that promise. If you think about it, because like you guys, we're sitting right above what was the biggest Bed Bath & Beyond in America, and it's empty right now down below us, right? And this was 2 years after the CFO of that company sadly threw himself out of a window remember that? Because things were so bad here in New York. And to your point, it's like that scene in Jerry Maguire when he finally like kind of leaves and everyone stops and he's
Who's coming with me?
Who's coming with me?
Nobody.
Who's coming
Dorothy.
with me? And everyone stops and it's this poignant moment. And then, the one woman gets in the elevator and everything goes back to normal. I mean, that's really where we are right now.
It's not good or bad.
Yeah.
It's good and bad, right? There will be great things and there will be terrible things for individuals. But as a whole, I tend to be more optimistic than glass half full. This is the end of society. We're all fucked. I just don't.
No, I mean, I don't think that either.
It's a culling.
Yeah.
It's the shittiest companies don't make it.
Yeah.
This is not new. You could argue that maybe the pace is faster, although the credit markets for high yield debt would disagree with you. But lower quality businesses that don't survive is nothing new. It's every era, every new technology, every interest rate regime, every economic cycle. It's an endless parade of brand names that one day it felt like they were one of the most important companies in America. Everyone could sing along to the commercial jingle.
Yeah.
You knew their colors, you knew their logo. And then the next day they were gone and life went on. And so if you are a low-quality operator or you have a management team that doesn't figure out the next technological shift and get ahead of it, et cetera, et cetera, et cetera, eventually you lose.
Yeah, and listen.
But somebody new comes...
No, I get that. I know.
We will never,
with the
human
ATM
beings,
and the
we
banks,
will never,
I get it.
We will never stop coming up with new ways to spend surplus money on leisure, on necessities, on goods, on services.
It's like positive cannibalization.
Listen, in the stock market, and I want to talk about valuation, Mike, because you had a really great post on the Irrelevant Investor earlier in the week, and we're going to put that in the show notes about valuation. But like again, this AI trade is going to broaden out dramatic. Well, no,
it's again, a lifestyle.
Listen, it's going to broaden, but my point is it's going to broaden out. At some point, people are going to be looking at industries that we haven't focused on a whole heck of a lot, and then there's going to be, how do you get this thing that trades at 13 times as a sector up to, let's say, a market multiple, and it's going to be all these narratives in around generative AI and productivity gains and all that. Like that's what comes next, and we saw that in the .com thing. But let's go to valuation for a second here before we kind of talk about some of those industries. Mike, you made the point in your post, and it was, why are U.S. stocks so expensive? Make the case of like why this kind of was on the tip of your tongue earlier on in the week, because a lot of folks have looked at a lot of these names, some of the early beneficiaries, at least, and why Microsoft at 35 times is fine, why Nvidia had grown into that 35 times multiple, especially given the growth, that sort of thing. And we know that also at the lows in 2022, if you X'd out those top 10 tech stocks, most of the S&P was trading at a trough multiple. So like that's really important. So why valuation, not a good timing tool.
The worst.
Why did it hit your radar
for the
this
last
week?
15 years, anybody that has said anything about valuation has lost money.
Yeah.
And I'm not saying that that's a great investment thesis not to worry about valuation. Of course,
You think from a macro standpoint?
I'm just saying, if you're waiting for things to return to the way that they used to be, I used to be able to buy IBM when IBM was a great company at 16 times earnings.
Yeah.
That doesn't exist anymore for a myriad of reasons. Of course, one of them is the fact that people are treating their 401k as a savings vehicle as much as it is about an investing vehicle. And
explain that for a second.
So these people are not price sensitive. And again, this is not an index. This is not an active passive thing. It's, I'm saving for my retirement. And every 2 weeks, if stock market is at the all-time high or if it's crashing, every 2 weeks, I'm going in there.
Yeah.
And that has a fundamental impact on the stock market. I can't quantify.
It's trillions of dollars.
I can't quantify what it is, other than to say that is definitely one of the reasons why the CAPE ratio has been so abnormally high, not the last 3 years, for the last 20 years, even in 2000.
Do your clients care about valuation? I mean, that's another question.
Everybody cares about valuation.
But we have to talk about these things a lot. You guys have mics in front of your face 3 times a week. This is just your podcast. Then Josh, I know you and I are on CNBC a few times a week or whatever. When you're trying to kind of demystify some of these topics, as you do very well in your blog posts and on your pods, Mike, you have to come up with different things that help contrast this sort of stuff, right? And so one of the things that we've always used as a bit of you could call it whatever it is valuation, comparative valuation. Whether it be a market, whether it be an individual name, whether it be sectors with, you know what I mean, like within the markets, that sort of thing.
When you're looking at the price to earnings ratio on Yahoo Finance, do you think that there's an edge? Do you think that there's any information in there? I think all of the stuff that we're talking about, while fun to debate, it is a major distraction to what ultimately drives the stock market. It's very simple. It's earnings, dude.
So let me ask you
it's
this.
earnings.
On the halftime report and on Fast Money, if we are totally going to disregard valuation as like an input, as a talking point,
I don't think totally disregard is the right way.
What are you left to?
No, the question is, when Mike says the term CAPE ratio, let's define what that means.
Yeah.
This was the heart of the debate over the last 15 years. All the people that know more than everyone else were very hung up on this idea that if you pay too high of a valuation for the market relative to its own history of valuation, that you're in for nasty trouble. Like that was what you were told by the village elders, and you listened to them. And if you did, you missed out on the second best bull market ever. What were they seeing that ended up not mattering? They were seeing a market 20 years ago that was selling at an elevated multiple on 10 years worth of earnings. So that's season. They're taking out the cycle, and they're saying, on average, this is what the S&P 500 usually sells at. But
what were the biggest stocks? It was Walmart and Exxon and Johnson & Johnson and Chevron, and like these are not. This is not Apple. This is not Google.
So this is what they missed, and it's not their fault. They presupposed that the next 10 years, from 2012 to 2022, they presupposed that 10-year period forward would look a lot like every other 10-year period throughout history. And here's what was different. The internet and cloud computing enabled businesses like Apple, Microsoft, Amazon, Alphabet, Meta to run 40% growth and 50% profit margin for years and years and years and years. And that should not have happened if you're a student of history. It never happened. Or if it did happen, it was one select company for 1 year. This happened for the 5 biggest companies for 10 years.
Yeah.
So what do you want these people to do? It's not their fault. They trapped themselves in this paradigm, and what they didn't understand was that the market was no longer comprised by businesses with 5% profit margins and 8% growth.
Yep.
That's the old S&P 500.
So valuation definitely matters, but you can't talk about inflation without talking about income, and you can't talk about valuation without talking about earnings and margins. So my point is not that I would prefer the stock market to be at high valuations, but I think that for most regular people, if you think, stocks are expensive, what do I do? Mm-hmm. You lower your expectations. Yeah. That's what you do. You don't say, I don't want to own stocks today. You just say, okay, stocks have done 42% of the year for the last decade. I'm probably not going to get that for the next decade. Yeah. Maybe I'll get 6%.
Yeah, listen, you know, I don't know if you guys recall this. I think it was late March of last year. We were on here and we were debating some of these very same issues, right? And it was sort of a different market. It was right after the Silicon Valley Bank. It was right after a bear market in 2022 that I think was something that was very unusual to most folks. You know what I mean? Because if you blinked in February and March of 2020, you missed that 35% drawdown in the S&P 500, right, during COVID. And so we hadn't had a proper sell-off in stocks in a very long time or so. And, you know, one of the things that I said is, listen, you know, I'm going to show called fast money.
Wait, we were still in a bear market. Sorry to cut you off, but we were still very much in a bear market in March 2023.
Yeah. No, I mean, listen, like a lot of folks were doubling down on their multi-year down, you know what I mean? Like down for the markets and that sort of thing. I was not particularly optimistic by any means whatsoever. And I think, you know, one of the last things I said is like, listen, if I'm you two, and I'm like at Ritholtz Wealth Management, and I'm talking to your audience, you know what I mean? But I'm not like, I'm at Fast Money. I have this mic. We're doing things real time and this and that, whatever. I grew up in the business trading stocks, long, short, trading options, trading futures, doing all this sort of thing. So my lens is very different than so.
Yes.
But I said, this is what I'd be doing if I think about all these secular trends. We were talking about ChatGPT-4, and at the time I had no idea it was going to do the things that it was for the picks and the shovels and what it meant for Nvidia having a hold on this GPU market where all of their competitors were left flat-footed, not anticipated, including Apple Computer. Yeah. Like, think about it. Apple had no generative. They were still building a car, right? Like that they just scrapped. So I guess my point right there is, what did I say to you guys at the time? What I would do, Qs and 2s. I would just say, like, I'd buy the same amount of QQQ every week or every month or whatever that period is, whether it's up 40%, whether it's down 40%. And that's the thing that I think, to your point about the 401k, as not just an investment vehicle, but as a saving vehicle, that's the thing. But I guess, like, we have lots of folks that come to us, they're in it for the sport. Yeah. They love this sort of stuff.
Dude, we love the game. I love it. I mean, I buy and hold stocks. I love it. I think that just looking inside the market right this second, it's Wednesday, March 20th at 11:35. What are like the short-term risks that your audience might be into? Like, this might be catnip for them. It's that you've got the VIX, where is it, 12 or whatever it is. You've got fund manager survey, pretty damn elevated. Yeah. You have the bull-bear spread. There's like no bears to be found. Highest level of bulls since 21 or 22 or whatever, something like that. You have unemployment, about the economy. It's Goldilocks. And then you have the stock market breaking out. You have basically every sector is trading higher. There's no credit spreads are as tight as they can possibly be. Yeah. There's no fear whatsoever in the market. And that's not a bad thing. Yeah. That's not a bad thing. But I'm just saying, if there could be something that people could point to and say, well, where's the next 5% downside risk? Well, it's this. It's something that could very easily knock us off course.
Yeah.
Yeah. I think you should be rooting for that. If you're listening to this podcast and you're 78 years old, it's likely that all the money that you'll ever make and invest is already in the market. So I apologize if you don't like what I just said. For everyone else who's listening, I think you should be rooting for the next negative catalyst. If you're a forced saver and you're putting money into the market every 2 weeks, no matter what, why are you rooting for higher prices? I've never understood that mentality.
Well, you know why? Because psychologically, people like to see their accounts at all-time highs.
So psychologically, people should think, hey, if the market comes down and I'm not using the money anyway, I'm way better off buying lower than higher.
Well, but there's two things. Number one, people like seeing their account at new highs. Obviously, they don't like to see themselves lose money. And it's not just the first 5% that they're worried about. Whenever we get a 5% pullback, you're afraid it's going to turn into a 10% and it just cascades.
Agree. And that's why we have a job. And I think one of the things that we have done over the last 10 years since we founded the firm is we didn't allow people who are working with us to engage in worst-case scenario fantasies.
Yeah.
We helped people tune out the people for whom they never woke up and said a positive thing about the market. The media will continue to book those people. They get a lot of attention. They generate a lot of clicks.
There's not many of them, Josh.
Well, there's not many.
Listen, I get tagged as one of those people, but you and I, we've had this conversation.
No, you're not one of those people.
No, but we get, listen, like I know who I am in the market. Do you know what I mean? I know who I am as a pundit. And, again, one of the reasons that I've taken a little bit of this heel thing, and I've been doing CNBC now for almost 15 years, is that when I started doing it, listen,
you think that you're the villain on CNBC?
Well,
no, Dan is the heel
on our program, and I always have been. Yeah. Oh, no doubt. Oh,
I never picked up
on
that.
Do you don't watch Melissa?
I
look at me,
and
she comes. I know, but she comes to me, and listen, I enjoy it. I don't mind because
your role is to pour water on anything that
it's
sounds
not even
like
a role.
it's positive?
I'm not saying it's like when I started doing it, 94% of the people that would come on those programs were just telling really nice stories about whether individual names, about markets, about economies, about market participants, and that's fine. Listen, you just said yourself as an optimism. I am an optimist, but people who only know me from Fast Money over the last 15 years thinks I'm probably the most dour guy you've ever sort of meet. We've all hung out,
but it's also
away from the market.
It's different time horizons.
Well, no, but my point is like I grew up in this business in the late 90s, and I was a bull market baby, man. Like I was trading the XCIT, the AOL, the YHOO, and we were trading them both ways. And I was optimistic about what those companies presented for the economy, what they presented for the markets. And that was obviously a massive paradigm shift. And I guess the only point that I'm trying to make is like, I came into this business. If you were bullish on something, you better know what the opposite part of that story would be, how that trade or that investment could go pear-shaped. So that's what I like to try to articulate, you know what I mean, as we're doing the pods, as we're doing the shows. That's how I'll be helpful to investors.
You said to yourself, like, part of this is for sport and for hobby and enjoyment and the love of the game. And that's what I do with my fun-ish account.
Yeah.
Now, it's a little bit more money than like fun money. It's like a decent amount of change. But also, I also have my 401k and my IRA and my taxable every month. And that is buy, hold, forever, don't do anything ever. And then I have this part of it where I am having fun because I love to do it.
Well, you want to hear something funny?
Yeah.
So I had two people that when I started in the business, I had two people pull me aside and let me in on a secret. And one of them is no longer in the industry. He lives in Boca now, and he is like in the health food business. But he was like the top producer at the first firm I ever worked at, and I was not managing money or anything. I was just a cold calling stockbroker. And I asked him what he does with his own money, and he pulled because we were trading Asian technology stocks that we were making markets in, right? And they were rips. You would sell a $9 stock that your trading desk going for $7.50. There'd be $1.50 in the middle. Mm-hmm. The firm would take half. The broker would take half. Mm-hmm. This was the business. Mm-hmm. It's not that we didn't believe in the stocks. It's that for some reason everyone was selling the same stocks.
Well, back then it was sport. I mean, let's be clear.
But my point is, so this guy would just be the most incredible producer, selling companies, Flextronics, Smart Modular, Sanmina. Mm-hmm. These were basically Asian
contract
companies, but with a U.S.-based management team on the New York Stock Exchange or on the NASDAQ. Or on the NASDAQ. If they were on the NASDAQ, you knew it was a honeypot for the brokers. Anyway, I said, what do you do with the money? He just punches up an index fund. There were no ETFs at the time. Yeah. So he just shows me an S&P 500 index fund. And he said every month, all the money I don't spend goes right into this. And somebody told me to do that 10 years ago. And that's all I've ever done. And that's all I really do. And that insight squared with something that I heard 10 years ago from someone who was very senior at Vanguard, who was dealing with hedge fund managers, macro, the bears, the guys that were trading currencies, this and that. And he said, it's so funny. I hear this guy come out and predict all this shit. And then I look at how what he's doing with his own money. And it's just VOO. Yeah. It's like literally just buy the market, buy it over and over again. So it just seems to me that there's tons of reasons to be bearish. There's tons of reasons to think that there's going to be a correction or a short-term market issue. But if you actually look at what people do in real life, real people put money to work and leave it alone.
All right.
And we hear that over and over again.
So I have one thing that makes me very nervous right now. And to be frank, it made me nervous $300 ago. And this is Nvidia trading at $900.
Why are you nervous about it?
Okay, because I've never seen to the scale. Okay, let's just start with their financial performance, okay? 3 years ago, okay, $25 billion in sales. Last year, $55 billion in the year. This year, 110. amazing. Okay, it is a 70-something% gross margin company. They have 85% market share. It's amazing. Okay, like let's be clear on that. So I have never, and you have never, seen anything like this at this scale ever again. If you go back and look at the last major paradigm shift, which was mobile, and Apple wasn't first to it. We all know that, but they made the first device that everybody wanted, and they had 90% of the gross margin, okay, in the entire smartphone industry for years. And think about that, okay? This company in 2009 had like $50 billion in revenue. This company, Nvidia, just went from 50 to expected 100 plus in 1 year. And when I think about the $1 trillion just this year that has been gained in market cap, it's pulling forward almost every amazing scenario from here on out, in my opinion. So then I think about this stock as the second or third largest market cap company, and I say to myself, okay, it's bringing up a super micro that was a $5 billion market cap company in the Russell 2000 a year ago. Now it's just added at an all-time high. You know what the company does? They sell $2 billion in shares. You want it, investor? You got it, right? Like that sort of thing. So I worry about, we were focused on the concentration of this Mag 7. This was like 6-7 months ago. Now we're worried about the concentration within semis, which is massively outperformed. So I just worry about those sorts of concentrations. They have the ability to break something. That's just a matter of fact. I'm just saying that to you. Okay.
What could they break in your like? What are you imagining is the thing that could go really wrong if the semis have been great leaders for the market?
Well, it's narratives, right? So think about, we've all gotten comfortable about Microsoft at 35 times, you know what I mean? Because they're going to be a huge beneficiary of Gen AI. Dell Computer, after they reported their last quarter, because the server demand in and around this trend went up 20% like that. Okay, this is not a company that's been on anyone's radar, or for the most part, in a long time. I think that so this narrative is broadening out, and that's great. You would say that diversification is bullish, but then I'd look on the flip side. Broadcom hasn't seen an uptick since they reported about 2 weeks ago. Adobe, this is a company that a lot of folks thought this is a $250 billion market cap company. Since they reported, has barely seen an uptick because the Gen AI stuff is not there. So I just worry that if we were to ever have a recession, if these companies can't commercialize, forget Nvidia, because everybody wants their product, but their customers, okay? Nvidia has 40% among Google, Microsoft, Amazon, Meta. All those companies are trying to develop their own GPUs, right? So what I'm saying is we could be on the cusp of something that doesn't look too different than 2000, 2001. And, and just to quote The Wire here, the game's the same. It's just got more fierce. And the concentrations, all those sorts of things. So again, no one can envision this happening. That's the point I'm making to you right now. I still have PTSD from 25 years ago a little bit. Does that make some sense to you?
I could totally envision it happening, but I might draw a different conclusion on what it ends up doing to the overall market. Because one of the things that's true about 25 years ago was that if you had a portfolio in anything but tech, by 2001, you were feeling okay.
Yeah.
Then you had 9/11. But then by 2002, if you looked at Berkshire Hathaway, it underperforms the whole way up in the late 90s. They put Buffett on the cover. They laugh in his face.
Yeah.
He's buying Mohawk Industries, which makes carpet. He's buying aluminum siding companies. The stock can't get arrested. But within a year or two of the dot-com crash, Berkshire Hathaway, I think, was making a new record high. So there were,
but it took the Nasdaq 14 years. But the one point I'll just say is, so the next leg.
That's
but
the
Josh,
point.
hold on.
So is your whole portfolio in AI-related names?
But hold on.
Yeah, you might have a problem.
So the next leg of this, and you can call it a bubble. And I hate when people just say, if you use the term bubble, that means that you're calling for like a calamity, a crash, or this and whatever. Bubbles can inflate for years. We know that the S&P rallied 30% a year from 1995 through 1999. My point is, it's going to work its way into other industries that are going to be perceived beneficiaries of this technology, and there's going to be all sorts of headlines that come out, and they're going to be buying some industrial stock or some retailer or something like that. So what my point is, this goes back to this conversation about valuation. Not a great timing tool, but at some point it might have the ability to distort the rest of the 493 in the S&P 500, and it sets up for, I think, a prolonged period. Think about how orderly the sell-off was in 2020.
Non-AI stocks becoming an AI-related bubble?
Well, ultimately, I think that's what happens next.
Well, listen,
if you think that the S&P is going to 6,000 unabated.
So how bullish are you then? Because it hasn't begun yet.
So Dan,
it's gonna happen.
Higher valuations make the market more fragile.
Yeah.
It can make, if the air comes out of it, it can make for a nasty fall. The reason why I'm not super concerned with Nvidia today, and I share your concerns that maybe it's pulling forward growth. I mean, of course it is. Let's be real. If the rest of the market were not doing what it was doing, I'd be more concerned. But look at industrials.
Yeah. Look at financials.
Look at materials, financials.
I get it, dude.
The market is going straight up. So if Nvidia and AMD were the only two stocks holding up the market, I'd say this ain't good.
But it's funny, AMD's down 20% in 2 weeks.
Good.
I know, I understand, but what I'm saying is like, might this be the precursor for like it's as good as it gets? Jensen Huang stood out there in front of 16,000 people like a rock star. Okay, like think about that. And people were gagging over every word he had to say about a fucking GPU that nobody even knows. Like 98% of the people who were not in that arena.
People said the same thing last May after that first blowout quarter that put everyone on notice.
For 6 months, Josh, the stock went sideways.
Dan,
that's great.
I know.
Beautiful.
I know.
But Dan, people said that's as good as it gets. They can't do it again.
You know what? You say
and
that.
They did it again twice.
On January 5th, I went on Fast Money and I said this stock is about to explode at 490. Okay,
good call.
Okay, but my point is that I get tagged for the guy who's ho-humming everything.
Not by us.
I understand this technology more than 99% of the people. I spend hours a day reading about it. Trust me, like I get this stuff, but I also get psychology, and I want to bring you to another huge this was going to be a paradigm shift within the automotive industry. Okay, 3 years ago, Tesla was $1.2 trillion market cap, okay? And think about this, okay? So they just basically shipped 2 million cars last year. They had the best-selling car the world over in this Model Y, okay? They're going to go X growth this year on deliveries. The stock is down from $400 to $180 or $170 right now, okay? And it pushed the entire global auto industry to move towards a thing that is not working out right now.
It's like
the
Netflix.
Entire global, and listen, this might be a blip. I get it. But what my point is like, think about how quickly narratives can shift, right? And
you're missing your own point.
But look,
you're missing your own point. Tesla just lost $500 billion in market cap.
Who cares?
And the Nasdaq's up 30% over the same time frame.
I'm not missing that point. I'm not trying to broaden it out.
That's the point.
But I'm talking about narratives in markets, and when
but
narratives
that's the
in
point.
markets
you
come
could break
together.
No. You could break the narrative for a handful of stocks, even if they're really big,
but Josh,
psychologically
there was
important
only
stocks.
one EV stock here in the U.S. that that incorporated the entire global market cap of autos, okay? So what did GM and Ford? If you look at the charts of Tesla and GM over the last year, it's pretty fascinating. One's up 60% off its lows, the other's down 50% from its highs.
Okay.
And so my only point is, when in past bear market cycles, when they've been predicated on these new paradigm shifts, when they come undone, correlations go to 1. That's the point I'm trying to make here. And I understand what you're saying. You're looking at one stock that you put way too much importance on relative to what the S&P has done over the time period, which it was added to the S&P in November of 2020 or December 2020. That's when it was actually added into. It's been a train wreck. Tesla's been a horrible stock.
But the market is fine.
I understand.
So who gives a shit?
So
and if that happens with
more,
Nvidia, don't you think some of the other companies will be the beneficiary of that lost market cap from Nvidia? Don't you think you'll see that same shift that you always see?
We'll see. My point is that Nvidia and Tesla are two very different stories, but the narratives aren't too different. Okay?
Well, the narrative
they're built on cult-like followings. But now what Nvidia has done, it's literally in 2.5 months. Think about the acceleration from the lows in COVID, okay, in March of 2020 to the highs in 2021. Okay, Tesla did gain $1 trillion in market cap. Okay?
But the difference is, Dan, that Tesla was never a narrative for the overall market the way that Nvidia is, to your point. So if the AI story breaks, because that's what started this bull market, right, in November 2022. That's what kicked it off, was ChatGPT, OpenAI. Yeah. So if that goes, perhaps it goes to the market. But I guess the reason why we're talking past each other is, so let's say that Nvidia goes, and let's just say that the market loses some momentum and it gives back 15%. We don't care.
Well, but you should. I'm going to tell you why. Because if Nvidia goes, then the hyperscalers go. Okay, Google Cloud goes, Amazon, they go lower because they're the customers, okay? And if they're not being able to actually increase demand for, let's say, first cloud.
We're not scared of bear markets, son.
No, but that's fine. And I get it. Listen, guys, when we were still in that bear market that we just talked about a year ago, my advice in the if I give it, it's just keep dollar cost averaging in the things that you know are going to be exposed to all these secular trends. And that's what the QQQ is.
Here's a question for you.
Yes.
You're worried about this. It's not an unfounded concern. It's happened before. What do you do about that worry?
Well, I think that
you just keep buying. Not to sound too cavalier, but you just keep buying.
I understand.
But what you can't control it. So what can you do?
Can I tell you this?
You can control yourself.
You guys don't do single stocks at Ritholtz Wealth Management, and you know this, and I know this.
We have thousands of single stocks. We're doing custom indexing.
I understand, but
thousands.
You're not recommending individual names.
Correct.
We're
not
a brokerage firm.
It's not discretionary.
So we're in agreement, Josh.
Yeah.
Okay. What I know. Because since I've been doing CNBC, since I've been in the business, so CNBC for 15 years, but in the business in the first 10, fully institutional and no media, I've met thousands of people who think I'm a smart guy about the markets. They come to me and I hear all the fucking stupid things that they do at highs and they do at lows. And they don't know their highs and they don't know their lows, but the psychology is the same. That's the point that I'm trying to make.
Yeah,
okay,
totally.
I know we agree on that. So what I try to do is just saying, if you want exposure to Nvidia and this secular trend that's going to have a long tail of decades, it's going to look like the internet of investing in that in the late 90s, and here we are in 2024. The biggest market cap companies in the world are the ones that people were most excited about back then. If that's your view, be careful on the single names.
We agree.
That's what I'm saying.
You're 100% right to tell them that. And I said on television, I feel bad for the people who just learned the Nvidia story over the last couple of months.
Right.
Like, I feel terrible because they're now coming in really excited about something for which we might have already seen the next 3 years worth of earnings growth
we're in agreement
priced
on that.
in.
Yes.
I said that literally yesterday, so you and I completely agree about this. I think the difference of opinion is, well, what do you do about it? Because you really can't know if your opinion about how the future is about to shape out is right.
As a pundit, Mike Batnick, I am, again, to answer your question, what do you do about it? I get concerned about the level of confidence that I see on people on CNBC or on the internet about buying Nvidia right here at $900 at trading at a valuation that has grown into. No, I know, but so again, I go back to who I am in the markets, who I am as a pundit, and I'm just going to kind of try to lay out how the other side of that.
I want to stop you though. I had debates about the valuation of Nvidia 5 years ago.
Yeah.
So I had people on the show on a daily, not once, on a daily basis. I think you should buy Intel and not Nvidia because Intel is 12 times earnings and Nvidia is 80 times earnings. To which I would say, not in these exact words, go fuck yourself.
Yeah.
These are people that fundamentally had no idea the difference between a CPU and a GPU and certainly couldn't tell you the difference between a training chip and an inferencing chip. And so to have those discussions that start with valuation or start with, look what this stock just did over the last 12 months, you and I both know you're talking to literally a wall. So I don't even engage in it. And now, again, it's scary because you have people coming to the Nvidia story thinking that they discovered something. And it's like, dude, we are already pricing in this AI revolution and then some. Not egregiously, 34 times forward earnings, but this is definitely not a new story. It's new to you, but it's not new to the investor class. So that is a definite concern. You see it everywhere. I have people come up to me and ask me, what do you think about Nvidia? What do you think about the earnings? What do you think about this? And it's like you feel helpless to help them.
Well, also
they're going to have to learn.
Look at the volume. Look at the volume in NVDL, the 2 times levered long Nvidia thing. That has gone parabolic along with the stock.
Yeah.
So yeah, when people are going to get burned, there's no doubt.
Nvidia is its own casino. It's like $5 billion worth of options volume a day or something. It's like a game. It's at this point, it's a game.
And that's kind of my point here. I've seen this before. I know how it ends. I don't know from where.
Well, but we don't.
I kind of do.
Know.
But we're gonna listen. We're gonna refresh this. Okay. Like hopefully we're gonna keep doing these conversations because I really enjoy it. As you can tell, it's very fluid. We literally had a rundown of like 10 topics. I think we covered 2 of them, which is absolutely amazing. But I hope we kind of
that's so us.
Yeah, no, but but you know what? Listen, let's end it like this. I think that the 3 of us, including I'm going to throw Guy Adami in here because we've had these conversations with him. We wanted to do this sort of stuff. You guys started writing. I started writing a long time ago because I didn't like the format of having sound bites and being mischaracterized and not being able to go in the level. And you guys have done an amazing job, Mike. You still write. You've stopped writing.
No,
he's back.
I'm once or twice a week now.
Oh, you are?
Yeah.
Okay. Well, okay, that's amazing.
Should read the last thing I wrote. It was out of control.
Okay, so this is on the road. Did you rename the blog or no?
Yeah, it's downtownjoshbrown.com.
Okay, well there you go. We're gonna plug that. Okay.
Dan, can we give you a present?
Yeah, you can.
Okay.
Of course you can.
Michael and I wanted to wanted to show you a token of our appreciation for just what an all-around mensch you are and you've always been to us.
Thank you much. Can I open it right here?
Of course, dude.
I really appreciate that. Well, I hope we drink this together.
It's a 1999 vintage.
So I didn't want to bring you tequila because you're extremely well stocked. That's a very good bottle of Italian wine. I assumed I'd be handing it to Guy as well.
Yes, that's amazing.
You two guys pop that.
We're gonna pop that.
Please, without
well, listen,
I
I think our listeners, our viewers, we know they know how much we appreciate what you guys do. You guys are nonstop at it, And again, when we talk about inspirations, and you guys were talking about Barry first and who inspired us, I was always inspired by, the level in which you just engaged with your listeners. Obviously, your clients. This is a big focus of you guys. You guys basically say, "Read us. We're here. We show up every day." You know what I mean? That's really important to us too, and the level of transparency is great. So I appreciate you guys coming back here. I know Guy does.
Anytime.
And we'll
come
fans
anytime.
I know. Let's keep doing it.
Hey, can we help you name this episode?
Yeah, what do you want to
I had some ideas.
Let's hear it. Let's do it.
Nvidia, there is no ceiling. do we like that?
That's fine.
Okay. How about sky's the limit for AI Josh Brown?
Are we using that would be amazing actually, because this goes back to last year when you said Dan Nathan predicts recession. I love that. That was on the Compound and Friends. That was amazing. So
there's no top. Josh and Michael.
No, permanently high plateau.
What do you guys
make
take pride?
The never ending rally still to come?
Yeah, well, it's happening. Hey, one last thing here really quickly. So this goes back to the Nvidia and the Intel. On a day like today, we wake up, and again, this is kind of telegraphed, but Intel's going to get $8.5 billion in literally a grant and about $11 billion in loans from the government here. Like, the stock is unchanged on the day.
That's CHIP Act stuff.
I know.
It's sort of hilarious that Andy Grove of Intel wrote "Only the Paranoid Survive," and they just got smoked.
I know. Liz Young is coming on your pod this
Liz.
week. She just mentioned that book, by the way.
Have you read it?
On the Monday pod. No, I haven't.
Phenomenal.
But I did read Chip War by Chris Miller. Have you guys read that book?
That one I skipped because I heard him on 10 podcasts.
He was on ours too, yeah.
And I said, you know what? I probably got the gist by now.
It's good. I mean, but to the point, like, Jensen is not some sort of guy who's just come onto the scene. He's been the CEO of Nvidia for 31 years, and the story of that is in Chip Wars too. So it's really good.
See the size of that chip that he unveiled, though?
It was
a pretty big chip.
It was pretty hot.
It's like one of those party-sized Tostitos.
Yeah.
You can get a lot of dip on that chip.
I'm just going to say one thing about this is like what's going on right now, the level of interest in this one person, the fawning of the entire tech industry.
He's a cult figure now?
He's a cult figure.
Yeah,
and we've seen this before. And my only point is like at some point in 2000, somebody put one too many banner ads on Yahoo, and the whole thing came crashing down. It came crashing down from the data centers to Sun Microsystem to the ad tech, folks and this and that, whatever. And you can't put your finger on what it exactly was, but it was just like a little too much, a little too fast.
But do you think that like you could also say like Steve Jobs, there was like a cult, like a huge amount of adoration around him in the mid 2000s, let's say, and it didn't end up being some sort of like a blow up, some sort even after he passed away.
Yeah,
like the continuity that Tim Cook came in. The stock tripled.
They hit the paradigm. They hit that paradigm shift. He had set them up for it.
Yeah. I'm just saying it doesn't always have to end. I guess what I'm saying is,
but that stock's been cut in half too. I mean, like go back and look at when the stock. I mean, when China was a problem in 2018, that stock was down 50% from its highs, and everybody felt amazing about it at the highs. They felt horrible about it at the lows. You know how many people sold that stock down there?
Yeah.
I mean, you know what I mean?
And Berkshire Hathaway bought it.
Yeah.
But I just feel like it's true that Jensen won. The fact that you have people that don't follow the business news and don't know anything about GPUs are now like fluently talking about Jensen Huang. Yes, it's a moment, and the spotlight's probably too hot. But I'm just saying it doesn't have to become the worst case scenario. It could cool off.
Do you guys pay a monthly fee for a large language model?
No.
When do you think you will start?
We have vendors that are trying to sell us AI solutions.
And you know what they're going to have to do? They're going to actually have to embed it in your current cost. They're going to basically cannibalize whatever that offering is.
Yeah, they'll raise our prices.
So my point is,
they'll raise our prices.
They're going to try. Okay, and so like here's the thing: what if there's not enough demand for it, and they've already spent like double, triple ordering these GPUs at $50,000-$60,000?
All right, there's risk to Nvidia. We know.
No, but my point is,
I don't know if our vendors are buying GPUs. Our vendors are contracting with Amazon,
correct,
Web Services. But my understanding is they don't have to buy the right to use a server for the rest of their life. It could scale up or down depending on their demand.
AWS was growing at 12% the last few quarters. This was the lowest growth that it's ever had. That is the highest margin business for Amazon. So my point is, if there's not consumer or enterprise adoption for these products,
you'll get an air pocket.
You're going to have an air. That's the point I'm making, and that is the similarity to what happened 25 years ago or 24 years ago. And again, I'm not saying it's going to be the same thing. The last point I'll just make about Steve Jobs is that these were consumer products, and it did take a while for them to start to accelerate because you needed the ecosystem built in and around it. What Jensen's promising you right now, the ecosystem's here for you. So they're basically saying, hey, listen, if you spent all last year overspending on H100s, we got a software for that. You're going to pay $5,000 per GPU that's going to get it up to speed. So you don't, maybe right now when we don't have the supply of the Blackwell chips, you're going to be able to upgrade it. Now it's a recurring revenue. Listen, these are all narratives we've all heard before. Yeah. They're all coming together too tightly. And the Jobs thing was different because that was a big paradigm shift that was consumer-led. It wasn't enterprise-led. And enterprise spending comes and goes with all these sorts of trends, with the economy, with this side of thing. So that's the big difference.
This might be as good as it gets for Nvidia. We just can't know.
We cannot know. All right, we'll leave it on that. Mike Batnick, Josh Brown, thanks guys for being here. I really appreciate it.
Thank you.
Thank you, Daniel.